What do you call it? When the world's biggest economy borrows $4 million every minute, right as its largest creditor walks away. Imagine this. The U.S. enters the second quarter expecting $850 billion in cash and finds just half. At that exact moment, China unloads $1.7 trillion in treasuries, torches the dollar, and forces Washington to borrow $514 billion just to survive. Exchange rates spike inflation, surge as allies pull out, and suddenly U.S. debt stops being safe. This wasn't a glitch. It was a global signal. What happens next might rewrite the rules of economic power. At its current pace, the U.S. accumulates over $4 million in debt every 60 seconds. But that load became exponentially heavier after China began liquidating its treasury holdings. Beijing have sold off $1.7 trillion in U.S. bonds, triggering an emergency borrowing spike that forced the Treasury to raise $514 billion, a 317% surge from its February forecast, according to Bloomberg. The sell-off followed Washington's move to block U.S. banks from supporting a Chinese EV battery firm's IPO, a policy shift that weaponized finance and provoked an equally aggressive response. The consequence: the dollar plunged 9%, yields jumped, and gold prices surged as global investors fled dollar assets. The U.S. now finds itself financing geopolitical moves with money it doesn't have, while the world starts to question whether Washington can afford its own strategy. When J.P. Morgan and Bank of America were ordered to withdraw from the $5.3 billion IPO of CATL, China's dominant EV battery maker, the decision cut deeper than a lost fee. Though the 0.2% underwriting margin might seem negligible, Reuters reported the potential loss in future access to China's financial ecosystem could stretch into the billions. This was no ordinary IPO. The firm had ties to strategic technologies, and per the Department of Defense's Section 126 designation, was considered part of China's military-industrial complex. The banks were forced to walk away under threat of regulatory retaliation, but the result went global. China didn't just push back with rhetoric. It liquidated a significant portion of U.S. debt. Now, Washington is left absorbing both the market shock and the broader consequences of pushing private institutions into the center of a geopolitical chess game. The timing wasn't emotional, it was mathematical. China slashed its U.S. Treasury holdings to $759 billion in the first quarter of 2025, the lowest since 2016, while simultaneously raising its gold reserves to 2,292 tons, marking a fifth consecutive monthly increase, according to the People's Bank of China. This shift aligns with a years-long strategy to de-dollarize its reserves amid rising geopolitical friction. IMF data shows that the dollar's share of global reserves dropped from 64.7% in 2016 to 57.4% by the third quarter of 2024, reinforcing the trend. Unlike previous bond offloads, this wasn't a market reaction. It was a structural pivot away from U.S. dependence, signaling Beijing's intent to fortify its fiscal autonomy. But what follows when the world's second-largest economy starts treating treasuries as liabilities, not lifelines? The Treasury entered the second quarter of 2025 expecting to start with $850 billion in cash. Instead, it had $406 billion, less than half. This shortfall, exacerbated by the return of the federal debt ceiling in January, forced the government to borrow far more than anticipated. According to a Treasury statement, had the cash buffer not collapsed, second quarter borrowing would have been $53 billion lower. But that doesn't explain why officials clung to outdated assumptions even as liquidity evaporated. Bloomberg reported that Wall Street traders were bracing for a borrowing figure closer to $255 billion, not double that. The gap raises deeper questions about how fiscal policy is being planned in real-time crises. And if Treasury miscalculated its starting position this badly, what else might be off in their roadmap? Some analysts, including Wright's and ICAP's Lou Crandall, speculated that President Trump's tariff hikes might boost Treasury receipts, helping plug budget holes. But early indicators suggest the opposite. Apple reported a projected $900 million tariff-related hit in the second quarter of 2025, prompting internal discussions to raise the price of its upcoming iPhone. Meanwhile, consumer inflation surged to 3.4%, up from 2.2% the previous quarter, driven by elevated import costs. This isn't a short-term adjustment, it's a structural squeeze. As imports drop and corporate margins shrink, tax revenue may not keep pace with the mounting interest burden from higher bond yields. And if tariffs were meant to stabilize the balance sheet, the numbers show they may instead be tightening a fiscal noose. Behind every Treasury auction is a family paying more for less. With China's exit from U.S. debt markets, yields on 10-year bonds climbed past 4.6% in May 2025, pushing mortgage rates to a 15-year high of 7.8%, according to Freddie Mac. Auto loans breached 9.1%, and average student loan rates hit 6.6%, eroding affordability across sectors. The Consumer Price Index rose 3.4% in the first quarter, up from 2.2% the previous quarter, with food and energy leading the climb. That's not just economic friction, it's real-world compression. Bloomberg reported household purchasing power drop 5.1% year-over-year, hitting middle-income families hardest as essentials imported from abroad, now priced against a weakened dollar, climbed rapidly. And with the dollar having fallen 9% since Beijing's bond sell-off, the costs keep stacking. But here's the bigger problem. As Washington's financial maneuvering ripples outward, it's not foreign investors who absorb the shock, it's the U.S. consumer. In the wake of Beijing's retreat, U.S. allies are starting to move with caution. In the first quarter of 2025, foreign investors offloaded $317 billion in U.S. assets, marking the steepest capital flight since 2016, according to Treasury data. Saudi Arabia, once a top 10 holder of treasuries, trimmed its holdings to $126.4 billion, down 22% from mid-2024 levels. Simultaneously, a bipartisan push in Congress mandated BlackRock and Vanguard to divest $800 billion to 220 Chinese companies, further politicizing global capital flows. The result: Asian IPOs on U.S. exchanges plummeted, with only 28% of Asia-based firms opting for U.S. listings in 2025, down from 75% just 3 years ago. The Wall Street Journal reported that Tokyo and Frankfurt have seen a corresponding uptick in listings and bond demand. The U.S. isn't just losing investor confidence, it's forfeiting its monopoly on global financial trust. The quiet retreat of allies is often harder to detect than outright defiance, but far more dangerous when it starts to compound. While Washington leans on debt to fund policy and posture, Beijing is building exits. In 2026, China will debut a national credit rating system to bypass Moody's, S&P, and Fitch rating firms that, according to the China Institute of Finance and Industry, have cost Chinese state-owned enterprises up to 120 basis points in excess borrowing costs, despite superior fundamentals. At the same time, China is upgrading its domestic cross-border payment systems to reduce reliance on SWIFT, the dollar-dominated network vulnerable to U.S. sanctions. Parallel to this, BRICS processed $56.4 billion in transactions in the first quarter of 2025 alone, with nearly half conducted in local currencies. Bloomberg confirms these aren't fringe initiatives. They are systemic architecture shifts designed to insulate Beijing from Western economic pressure. And as more nations join China's financial orbit, the question becomes whether the US dollar remains a global currency or just a regional one backed by legacy status. The Treasury's revised borrowing plan, $514 billion for the second quarter and $554 billion projected for the third quarter, is premised on regaining a cash balance of $850 billion, a figure it is yet to reach. As of mid-May, the actual balance stood at $563 billion, up from March's $406 billion, but still 33% below target. According to the department's Monday statement, J.P. Morgan analysts flagged that assuming a smooth debt ceiling resolution is increasingly optimistic, warning that the market may not tolerate continued dissonance between fiscal promises and cash realities. Meanwhile, rating agencies are beginning to reassess U.S. sovereign outlooks, with Rights in ICAP's Lou Crandall cautioning that the Treasury's cash management strategy may require a full-scale recalibration if Congress fails to act. With BRICS advancing alternatives, China shedding dollar liabilities, and even traditional allies hedging exposure, the U.S. faces a binary choice: reform its fiscal and geopolitical posture, or watch the foundations of its financial dominance gradually replaced not by force, but by design. The numbers aren't abstract, they're happening right now. Mortgages are rising, investor confidence is fracturing, and the global economy is slowly rearranging its center of gravity. Beijing isn't waiting. BRICS isn't hesitating. And Washington's still betting that legacy power is enough to hold it all together. But the debt clock doesn't pause for politics, and markets don't trade on nostalgia. So let me ask you, what happens if the next Treasury auction doesn't go as planned? What if allies stop calling U.S. bonds safe and start calling them exposed? Drop your answer in the comments, because what's coming next, from interest rate shocks to reserve currency recalculations, may force every nation, company, and household to choose a side. And if you want to stay ahead of that decision point, subscribe, now hit the bell, and join us as we track the unraveling or the rebirth of America's economic leadership. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.